What's up, guys? Welcome back to the channel. In today's video, we need to continue our conversation on what is going on currently in the stock market. 2 weeks ago, I made a video about the stock market correction, and it's looking more like a stock market meltdown with a bear market coming. However, we need to discuss in this video what kind of investor are you, and do you actually care what is happening right now? As always, before we go any further, I must tell you I am not a financial expert, I am not a CPA, I am just some dude on YouTube that's read a couple books and watched way too many YouTube videos about finance and investing. So definitely do your own research and consult your own professionals and make your own decisions based on your unique circumstances. But a good way to put the current financial situation in context is, what kind of investor are you? This is really important, and I basically think of it this way. There's only three kinds of investors. There is a retirement investor. This is you are young and working and you're putting money in an IRA or a 401k or maybe even a private brokerage account that you intend to live on once you retire. And maybe this is, you're a FIRE investor and you're looking to retire by 40 or 50 so you don't have to work anymore. The second group of investors are just that. They're investors. These are people that work in the financial sector. It's their full-time job. This is the only thing they do. They think they're really good at it. For me personally, if there is a market downturn or a recession and that you chose this as your career, that's on you. This is capitalism. It's cyclical. This has been proven. We've got 400 years worth of data. Upswings happen, downswings happen. If this is your job, you should have prepared for the next recession and anticipated what would you be doing in this exact scenario. The third group of investors is retired investors. These are people that have already worked and saved enough money in their IRA, 401k, or private brokerage account so they don't have to work anymore. And they're dependent on dividends or distributions in order to live on that money today. This video is going to focus on what I am, a retirement investor hoping to live on this money in the future. Real quick, if you are a retired investor, hopefully you've diversified your portfolio and you have some money in bonds. Even if you don't, if you can maybe reduce how much you're pulling out of your retirement accounts until the stock market has time to recover, that honestly is your best option. But people are asking me in the comment section, what am I doing in response to this financial market meltdown? Do I care? What am I doing? And my answer is I'm doing nothing. And I feel like I need to explain why based on what I've read and what I've learned about finance and investing. The way that you need to think about it anytime you put money in your IRA, 401k, or government TSP is that you're putting in this money and you're agreeing not to see it until you're 59 and a half. That is usually the minimum age that you can withdraw for a retirement account. And when this money comes out of my paycheck every month, I say, oh man, there goes $1,500, $1,000, whatever. I am not going to see this money again for 24 years. I'm currently almost 36. So you need to view an investment in a long-term retirement account simply as that. It is your money, it belongs to you, but you're not using it, and you made a contract with your basically investment strategy that you're not going to access that money or use that money until you retire. So when I put money into my retirement accounts, once again, that's a lot of money, but I'm not going to see it again for 24 years. Here is a snapshot of what the Government TSP looks like. For those who don't know, this is the government's version of the 401k. I put everything, 100% of my investments in the C fund, and the C fund is the S&P 500 index fund. It broadly tracks the 500 largest companies in America according to their market share. Now, seeing your investment go down 22.93% so far this year, it's only been 3 months, is very startling, and it does invoke this emotional reaction. But you have to put it in perspective, and we can look at the summary of returns for the C fund going back to its inception date in 1988. So we currently have 32 years of data to analyze and look at. And for example, the C fund was up 31% last year. And what does it average? Since its inception, 32 years worth of data, it averages over 10%. In the last 3, it's been up 15, 11, 13. Now, obviously, it's been a bull market since the 2008 recession, so it's been overperforming. But when you factor in all the down years and the up years, the average is over 10%. And that is the investment contract that I've made with myself. When I have money taken out of my check and I put it into my retirement accounts, I say, hey, the market average is 10% for the S&P 500 index fund. I am comfortable with that. I am happy with that. You know, some years it's going to be up 31%. That's really weird. That's way higher than its average. And some years it's going to be down. It's going to be down 10% or 20%. Once again, long-term, over the next 24 years, I am looking for the average, and the average is still over 10%. I cannot highly recommend enough that you need to look at what is the annual returns for investment funds that you look at in the past in order to understand how much volatility just naturally, inherently, there is in the market. So here is the TSB Data Center. And we're looking at the funds going all the way back to the TSB's inception in 1988. Originally, there was only the G, the F, and the C. In 2001, they introduced the S and the I. And 2006, they introduced the life cycle funds. But when you look at the C fund, which is the only investing I do, some years it's up 31%, some years it's down 3%. You look at, 1995, it was up 37%. And then there was a really bad stretch of years. This was the 2001 terrorist attacks and the dot-com crash. Down 9, down 11, down 22, then up 28. Here's the financial collapse of 2008, down 36, but the next year, up 26, up 15. In 2013, it was up 32. Nobody remembers the great economic boom in America in 2013, in which the S&P 500 was up 32%. And this is just how humans react. This is just how people feel things. When things go up more than average or normal, we don't even blink. We don't say, oh no, it's going up too fast, I better pull out of the market. No, that's not what humans do. They take the positives, they view it as theirs, they don't want to lose it. They have an emotional reaction when they lose anything they gain. But once again, your agreements when you put money in a retirement account is taking the long-term average, because you shouldn't be seeing or touching this money for decades. Here's another way of looking at the S&P 500. It is a scale over time going all the way back to, let's see, 1928, 1929. And first thing you should know about this is that it is a logarithmic scale. So because in order for money to double 2, 4, 8, 16, 32, the numbers will keep getting bigger. That's why it kind of looks like this logarithmic asymptote. And we can actually click on log scale in order to account for it being a logarithmic scale, and this makes it look linear. So you go all the way down here to, the Great Depression of the 1930s, and then it just clearly shows an upward trend, and this accounts for global growth. And even with the 2008 recession, it still is pretty clear that this upward trend is that 10% that you're earning if you just stay in the market. And I waited to make this video today to prove a point. If you look at how the S&P 500 performed today, it was up over 9%. Now, there's a lot of people that have been panic selling or switching to bonds. And when you do that, you lock in your losses forever. I talked about this in my other video, but when your shares prices depreciate in value, you still have the same number of shares. Your shares don't, disappear. So you only lock in a loss when you sell at a loss. So for people who don't know what they're doing and they're just panicked, and they're jumping in and out, they're reacting to when it goes down, they sell, and then they react when it goes back up and they buy. And this is the worst possible investing strategy that you can have. Don't do this. Don't let your friends and family do this. So it went up 9% today. Is it going to go back down on Monday? Today's Friday. Probably, but you can just ignore it. You can just ignore it. Let's look at, the 1 month, the 6 month, the 1 year. And I don't care. it's gonna come back. It always has come back through war and depression and other disease outbreaks. The stock market has always recovered. If our entire economic system just collapses, then oh darn, I guess it was all for nothing anyways. But you have to just assume that like it's gonna keep working the way it has always worked. To reiterate my points, what is my advice to other people? Number one is do nothing. You've ideally have put thought into your long-term investment strategy and just stick with it. There's no reason to change it as of right now. The second one is buy more. If you have not maxed out your personal IRA, it's up to $6,000 in contributions. Now is a great time to buy. If you can increase your contributions to your 401k, you should do that. I personally increased my contributions from 25% of my check to 50%. I'd rather front load it now in order to buy while the shares are at a cheaper price. The only caveat to this is you need to have job security. If you work in an industry like hotels or airlines and you might get laid off or furloughed, then you might need to hold on to cash. Don't sell your investments, but definitely start creating that emergency fund, 3 to 6 months worth of expenses so that you can find another job and still pay your bills. But if you have the cash, if you have the job security, you should be buying right now. That is just my opinion. You can do whatever you like, but that is the advice that I'm going to give on this channel. And that's it. That's all. It doesn't really matter what the stock market does in the next month or two or year. It could go down even further. I don't care because I'm confident it will come back. I'm telling you it will come back. Okay guys, if you like this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I post mostly about military and finance topics, but I'd like to do some more traveling eventually when it's safe to travel again. And if you have any questions or comments, leave me one down below. I love hearing from you guys, and until the next video, take care.